Hello Internet, and welcome to Financial Journey, where I bring you the financial education my many years of school failed to teach. We all know that there is inherent risk in investing. I say it in many of my videos that discuss investing. Never invest money that you cannot afford to lose. So then, is investing in the stock market gambling? Is it basically the same as buying a lottery ticket or going down to the casino and putting it all on black? Absolutely not. There is a fundamental difference between investing and gambling, which I'll be breaking down today. The house always wins. This is the basic tenet of gambling that this more than $100 billion a year industry relies upon. When you walk into a casino, you know that every game is specifically designed so the casino has a statistical advantage. Sure, you may go on a heater and walk away a winner, but if you play long enough, the law of probability will ultimately pan out and results will resemble the predefined probabilities. A great example here is roulette. If you pick a single number in roulette and the wheel lands on your choice, you walk away winning 35 times your bet. Of course, given that the odds of choosing the correct number is 1 in 38, depending on the version, this is guaranteed to be a losing venture long term. Sure, one exception is poker, where a skillful player can actually leverage probability and skill to be a winner over the long term. But even here, the casino simply has no skin in the game. They just rake the money out of the pots occasionally for risk-free gains. The odds with the lottery are even worse. Sure, the bets are small, usually, nearly $1 to $2 per entry for most games, but with all the opportunities to play, it's very easy to spend $10, $20 or more per week chasing this dream, and that can amount to between $500 and $1,000 each year. Given that the odds of winning are around 1 in 300 million, for games like the Powerball or Mega Millions, you'd literally be better off just lighting the money on fire, as at least you'd get a few seconds of heat out of it. So how is the stock market different? Here you can see the annual returns over the last 70 years, not accounting for dividends. As you can see, there's little rhyme or reason to the returns, and not every year is a winner. Heck, in the financial crisis that began in 2008, the stock market was down almost 40% from where it began in January. Nonetheless, there are several important differences from a casino. First of all, when we look at these results, a quick thing that we find is, as a whole, the stock market trends upwards. This is why we're constantly seeing record highs year after year after year. In fact, since 1950, 72% of the time the stock market has been higher at the end of the year than where it began in January. When we dig in a bit more, we actually find that not only are there more winners than losers, but the average win is bigger than the average loss. But wait, it gets better. Sure, if you bought in the stock market just before the dot-com bubble burst in 2000, or the Great Recession in 2008, I am sure you are kicking yourself 1 year later. However, unlike with a casino, here the law of probability is actually on your side. Let's say instead of investing for 1 year, you invest your money for 10 years. For the sake of perspective here, I'm going to go ahead and keep the axes the same. What you'll see is, all of a sudden, there's a lot less noise. Here, each point represents the average annual returns over a 10-year period, beginning in the year on the x-axis. And there are data points for every 10-year period since 1950, even though not all year numbers are shown here on the graph. So 1950 through 1959 returned 13.6% on average each year. 1951 through 1960 returned 10.8% per year on average, and so on. As you can see, there are still some 10-year periods that average to a negative return. 88% of the time, 10-year investments were positive, and the average annual return for positive years was nearly 6 times the average annual loss during negative years. If we go out further to 15 years, we can easily zoom the chart in, as there is no 15-year or longer investment period since the Great Depression that has returned a negative return. Let me say that again. Since the Great Depression, 100% of 15-year periods have gone up in value. Sure, the worst 15-year stretch had very poor returns of just 0.9%, again not considering dividends, which would make that slightly better, but this was over one of the worst markets in stock market history, with 6 of the 15 years showing negative returns, including the 7th worst stock market crash in history in 1973 and 1974. Despite that, the investment increased by more than 14% over 15 years. Well, history certainly doesn't guarantee that no 15-year period will ever show a loss of value. The past 70 years suggests that at 15 years, it is a near certainty that your investment would have appreciated in value. Well, what if we look at even longer durations? Warren Buffett, one of the world's most consistently successful investors, has said, "Our favorite holding period is forever." If you were to buy and hold a basic stock market index fund that just tracks the S&P 500 over 30 years, we see a further tightening around the average. And now the worst 30-year period has averaged over 5% annual rate of return, dividends excluded, and that is since 1950. One last chart here summarizes everything that we've discussed. As this box and whisker chart demonstrates, as your time frame increases, the volatility of the stock market decreases. Stock market corrections and even crashes can and do occur with some regularity. But despite these drops, if you can invest your money long term, the presumed risk of investing in the stock market all but vanishes, leaving a very predictable and significant return. So is investing in the stock market gambling? If you follow the basics presented here, diversifying and hanging on for the long haul, there truly are few similarities. Where this comparison becomes more apt is when people are purchasing single stocks or penny stocks or businesses like GME, where the fundamentals just do not show a reason for their price. Particularly, you want to be cautious where you don't know anything about the business, and blindly purchasing investments certainly does carry intense risk. Individual companies, even large ones, can go out of business. So holding all of your eggs in one or even a few baskets may not match the results I discussed. If the stock market ends up essentially a quote-unquote sure thing, when should you not buy in? For those who follow the market closely, the downturns can be hard to stomach. So if you're emotional, this investment may not be the best for you. One of the most common mistakes that people make is panicking during a downturn and selling their stocks at the worst possible time, locking in their losses, only to buy back in too late and miss out on a large part of the rally. Do this a few times and you can easily evaporate the gains the market makes. However, the biggest reason you should consider avoiding stock market investing is if you're going to need the funds in the near term. It is entirely possible that in 6 months or a year or even 3 years, the stock market could be down 60% from where it is today. So if you're planning to make a home, car, or any other large purchase, the stock market may not be the right place to park your funds. And this is especially true for an emergency fund. That fund is the money that's supposed to be there when everything goes wrong. And in particular, if you lose your job. But when is the time that the most people find themselves out of work? That's right, during a market downturn or a crisis like we had in 2020. If the market were to drop 50%, facilitating you losing your job, you certainly then don't want the funds that you're relying on in such a situation to be affected by that same drop. So what do you think? Is investing in the stock market a form of gambling? If you're investing currently, are you diversified with mutual funds or ETFs, or are you simply buying individual stocks? Or are you even familiar with these types of investments? If you enjoyed this video or learned something new, please hit the like button down below for the almighty YouTube algorithm, and share this video if you know someone who could benefit from the content presented here. I'm posting every week on personal finance, managing debt, investing, and retirement. So if you'd like to continue that financial journey together with me, consider becoming a subscriber and ring the bell to be notified of new videos. As always, I'll see you in the next one.